why the property market didn't come down is because we had 640,000 migrants that came into Australia in 2023. 640,000 net migrants came into Australia. Our long-term historical average was 150,000.
So I think we'll get started. Okay. So good afternoon, everyone. My name is Dr. Mariam Joseph, and many of you knows me. I'm the president of the Assyrian Australian Medical Association. I would like to begin by acknowledging the traditional owners of the land where we are meeting today. I pay my respects to the elders past and present. Unfortunately, our scheduled chairperson could not attend today's meeting, so I had to step up in the last minute to prepare and run the meeting. I'm thrilled to see all of you today for our Sunday evening seminar. I'm confident that our exceptional speaker, Peter, will bring a wealth of experience to the table and provide valuable insights that you won't want to miss. Let's kick things off by ensuring our phones are on silent so we can fully immerse ourselves in the presentation. If you need to freshen up, you will find the restroom on my left, and there is another one outside the room. I would like to say a few words about Peter. Peter is the chairman at Wealthy, a VC-backed real estate investment platform, which he founded in 2017. He's also the founder of Esho Capital, a private firm specializing in lending to professionals and businesses. Outside of business, Peter is involved in several philanthropic initiatives. He is currently the president of the Assyrian Aid Society in Australia, and he's the founder of Esho Scholarship and startup mentor at the University of Sydney Genesis program. So without further delay, let's come together to extend a warm welcome to Mr. Peter Esho.
Thank you, everybody. Thank you, Dr. Miriam and the Assyrian Australian Medical Association for your invitation today. I'm very proud of you. It's very nice to see Assyrian organisations such as yourselves, particularly Assyrian organisations around professional bodies. We've had a lot of cultural, sports, religious, and we're quite sick of them. And you know, in this country, we all work hard and we build our professions, so it's nice to see professional bodies like yourselves coming together. Also on a hot day where you could be at the beach or doing something really nice. In terms of the agenda for today, I like smaller groups. Smaller groups work well because we get to have a conversation together. It's not me preaching to you and you listening. And I like having interactive sessions. So as we go, I'm not the kind of person that needs to wait till the end. You can interrupt as much as you want. If you've jumped ahead, I'll tell you to just wait. And if you raise something that I haven't addressed, we'll use that opportunity to discuss together. In terms of what I want to have a conversation with you about today, what we do at our business, our track record to help then set up the conversation that I want to go into deep with, which is where we are at the moment in the property market, where we find ourselves, and why I think professionals, particularly in the medical space, have a very good opportunity, which is sometimes underutilized if they don't have an investment strategy. And then I'll finish off around building a team and take any of your questions. So that's the agenda for today. Like always, it's very important for us to say that this is for education purposes only. There's no advice intended here. And our business is licensed under the credit license, but everything that we're sharing here today is really for educational purposes and meant to be helpful for you. Sorry about the venue also. We had an issue with Fairfield HQ giving me the wrong PIN number and the doors keep closing and opening, but we made it inside and everything's working. So, in terms of what we do at Esho Group, Esho Capital, we help professionals and businesses with lending and finance. Now, why professionals? Because over the past 5 years or so, many of the banks have developed products targeted to professionals. They started off with doctors, then lawyers, then accountants, and now they're moving on to engineers, they're moving on to executives. They basically want to do more and more business with this professionals category. And the professional category is becoming more unique than everything else. I'll talk about that a little bit more today, but particularly for you young guys, great opportunity to utilize the professions that you're studying and you're learning. Really the opportunity around the professional products that are out there in the market are around your borrowing capacity and your striking power. And it's a very, very good incentive that's on the table at the moment. We also focus on businesses. We like working with businesses, helping businesses grow. A lot of you are business owners. You're in the medical space, and as you know, your profession as a medical professional evolves into, by default, a business person. So you end up running a business, and that's a natural evolution. On the investment side of things, we specialize in helping people buy investment properties. And I'll talk a little bit more about that today. Investing in property is an actual system and a process. Welcome. And lastly, I put it on my slide. We're proudly Assyrian, and I think it's important for us Assyrian business owners to make that a bit of a badge of pride, because we've worked really hard and we're building great businesses, and I think we can showcase that. Just wait for our guests to join us. Welcome. This is the kind of projects that we've put together and we hope clients buy, and throughout the presentation I'll try to be as visual as possible. In terms of our track record, since 2015, this is the range of markets that we've worked in on the investment side, and these are the kinds of projects. I've put this up here basically to give you an idea. When I start to go into the market and I start to talk about where we kind of see opportunity, I want you to get a little bit of an idea as to kind of the experience that we've had and the places that we've helped investors. So a lot of interesting projects along the way. Before I go into the market, show of hands, who thinks the property market's going up this year? Who thinks the property market's going down? Oh, it's too expensive. Who doesn't know? Who doesn't want to put their hand up?
It will be going up until end of the year, maybe.
Who thinks the market isn't going up? No?
Isn't? Sorry.
Why?
I think it's stable now, mainly because of the interest rate.
Yep.
It's too high.
Yep.
And there's expectation that it will start going down maybe in September, so people are waiting. So
Wait, holding off?
yeah.
The reason why interest rates have been rising, and I can have this conversation with you because of your background and your profession, we can go deep today. The reason why interest rates have been rising is because the economy has been very strong. Let's not forget that. The Australian economy, we had an unemployment rate that was at its lowest level in 40 years, right? A sub 4% unemployment rate was previously unheard of. We had retail sales that were above trend. We had GDP growth that was above trend. Australia's biggest export is iron ore. We literally dig dirt out of the ground and we sell it to China for $150 a tonne. And we export millions of tonnes every year. The economy was so strong, and in hindsight during the pandemic, they went too hard and too strong to stimulate the economy. They gave too much government money out, and the Reserve Bank cut rates to 0.1%. I'll show you in the slides where we were in the 80s and 90s and 2000s, where we went in the pandemic, and how we're now recovering and adjusting for that overstimulus. But never forget, if you're investing, that rates rise when the economy is strong, and rates fall when the economy is weak. You give morphine to a client that has a medical problem, and you take them off the drugs so that they can recover. It's the same in financial markets. right? You take that morphine out, you take that painkiller away when the patient is less volatile. The biggest fear that the Reserve Bank had was that we would enter what's called a wage spiral, a wage price spiral. Because unemployment was so low, and because all the tradies, all the staff that you're trying to hire, trying to get anybody to do anything became really expensive because everybody had a job, there wasn't unemployment. The risk is you enter into a spiral. Cost of lawn mowing goes from $100 to $200. You're paying more, I need to charge more, he needs to charge more, and you enter into the spiral that doesn't stop. That's very hard to contain. And that was the biggest fear that the Reserve Bank had. Not necessarily the cost of goods, right? Cars, building materials, that leveled out after lockdowns. But the risk was with a tight labour market, once wages start spiralling out of control, it takes about 5 or 10 years to stop them. That's why the Reserve Bank and all the central banks around the world panicked and they started moving. Something really interesting happened in Australia that hasn't happened in a lot of other countries. The reason why the property market didn't come down is because we had 640,000 migrants that came into Australia in 2023. 640,000 net migrants came into Australia. Our long-term historical average was 150,000. You don't see it. You don't see people lined up. You see cranes in the air when there's supply, but you don't see demand because demand happens gradually. But the demand for housing is being felt in the rental market. The demand for housing is being felt when you go out to auctions. And the demand for housing has offset the cost of interest rates. If we just put interest rates up and didn't take these 640,000 people that came in, guess what? Houses would have hit the market, they wouldn't have sold, prices would have come down, more people list, and you get the opposite spiral coming down. But this saved the housing market. And this is a trend that's likely to continue. I'm going to show you some charts. Construction supply is also extremely tight. For those of you that have friends or family that work in construction, or even if you don't, drive around Sydney and the number of cranes that you see in the air is very limited. Very different to 2015, 2016, 2017. Why aren't we constructing enough for these 640,000 plus the natural demand? Because planning is broken. Planning is a state issue, and all the states have planning issues. The cost of materials went up. It's come down, but it's still gone up. Labour is very challenging because we're building hospitals, we're building airports, we're building billion-dollar metros, and all the big construction companies have to compete for that talent. And also, interest rates went up. The biggest cost to a property developer is the cost of money, the cost of capital. And when the cost of building an apartment project goes from 8% to 14%, the easiest thing you can do is hold off, keep that land because it's going up anywhere, and delay the development of those properties. Governments have been saying a lot. They've been doing very little. They've actually been doing nothing. If you have a look at New South Wales, we had a new state government that came in. Every week you see it in the paper. They're going to zone this and they're going to do that and they're going to build 1 million houses. They've done absolutely nothing over the past year. And our banking system is very strong. This is the reason why we find ourselves at the moment in the current property market that we have. This is inflation, and as you can see, the cost of everything jumped and exploded after the pandemic. But more importantly, it's starting to come down. The inflation rate is starting to come down. And this is interest rates. This is the cost we pay on our money. So as you can see, these two lines move together. They lag sometimes, but they generally follow the same trend. And that's why, as Sargon was saying, towards the end of the year, there's expectations that interest rates start to come back down because inflation starts to cool down. Migration is the biggest impact at the moment in the demand side of the market. Every market's driven by demand and supply, but migration has an extra layer on top on the demand side. As you can see, this shows you the amount of migrants coming into Australia. This chart is actually a little bit lagging, but it shows you the trend. Because we closed the door and because we were the world's biggest prison during the pandemic, where we didn't let anybody in or out, we had a lot of catch up in migration to do. And so guys, the picture that I want to paint here is just how much demand in the property market has come on over the past 12 to 24 months, as illustrated by these charts. Remember, going back, we've had an increase in the cost of everything, we've had an increase in interest rates, but offsetting that has been an increase in migration. Before I go ahead, any questions? Sure.
One question. I was reading a few weeks ago that the government has planned 34 years ago that the population will reach 27 million in 34.
Yep.
Actually, it reached 10 years before that.
Yep.
Isn't that one reason this is happening instead of just putting everything on migrant, that the population already reached 10 years? The rate they didn't expect us to want, the government didn't plan for that.
Migration, natural migration, good question. Natural migration is population growth.
Yeah, reached already like 27 or 28 million, 10 years before the expectation. They
Yes.
expected to be 34.
Somewhat true.
10 years before. That means like there's no infrastructure planning for that, like for another 10 years. Is
Yes.
that affecting all these?
We'll get to that, but generally your population growth is about 1.5%. Net population growth is about 1.5%. So population growth gives you roughly, if you're 25 million people, you take 1.5% of that, how much is that, right? That's your net natural population growth. We're not having as many kids as we had 30 or 40 years ago, so average household is coming. People are getting married later, but people are living longer too. Right, so your death rate is not as high, which for the time being is okay, but you're going to have a population issue later. That's why migration is the biggest variable, short-term variable in the property market. So natural growth, yeah, but it's not as big as a factor as letting in 640,000 people in 1 year, plus the impact of that continuing. So this doesn't stop here and then go to zero. This year we're expected to go to about 400,000 migrants. And next year, so the year following that, we're expected to go to 250,000 migrants. So we're going to have about 1 million migrants that have come in the space of 3 years. 1 million migrants on top of what you're saying, which is the natural population growth.
Well, my question was, there is a 10-year lag in the plan. Like, they plan this infrastructure to be for 27 million in 2034.
I understand what you're saying.
Already, like this population has been already reached 10 years before without no plans.
Let's get to that. Let's go to that next. Sargon, I'll come to you next, right? Yes.
I mean, the question is this. That the sharp rise came because of sort of, it was a bait, right?
It was a what, sorry?
It was a bait. You know, if someone gives you money with no interest, they want you to have as much as you can and then they will hit you hard. And that's pathetic. You know? That's
You're talking about interest rates?
Yeah, I'm talking about like, sort of the global problem of the inflation. Is like recently like, sort of, it was pre-planned. It wasn't like something that came out of nothing, right?
So what's the question?
The question is this. How much can the prices of property keep going if there's no matching increase in the individual's income?
Let's get to that. Now, in every market, you have demand and supply. We've spoken about a few of the demand factors. Migration, rates coming down. At the end of the day, supply is the reason why property prices come down or property prices moderate. Housing is very different to a lot of financial assets because housing has a fundamental human need. We need houses to live in. And data shows that the number of people in an average house continues to come down, right? I think the average household is 2.4. It used to be high 3s. So we need more houses in order to sustain ourselves, let alone the increase of people that are coming. If we actually have a look at the population growth, 644,000 people that have come in, and we have a look at dwelling approvals are a very important factor because approvals give us an indication of the supply that's coming, right? Now, an approval doesn't necessarily translate into a building. I can get approval to build 100 units, but as I said, I may not build those 100 units. The best forward indicator of what I'm going to build is what was approved. That's the data we go off. And as you can see, we're currently approving, permitting, or allowing about 160,000 properties per year. So the supply side of the equation is showing us that even in a best case scenario, we're going to build 160,000 homes per year, while migration in itself is increasing by, what's that, 4 times? 4 times that. And this is why we find ourselves in this situation at the moment. That is why the market is doing what it's doing today. These are not all going to materialize because the cost of building these has gone up and the ability to build these. And this is moderating, but it's still at a very high level. Supply and demand is showing us why the property market is behaving in the way that it's behaving despite interest rates increasing. This is where the price data is at the moment. So this shows us what's actually happened to real estate prices. This is growth, right? This is the rate of growth. So as you can see, over the past 12 months, Sydney increased by 11.4%. The next best markets were Perth, Brisbane. They're actually better than Sydney, but Sydney is the most expensive market. So actual dollars of gains was the greatest in Sydney. And then you can see that all of the markets are rising. If there were individual one-off factors that were state-specific, yeah, you might see one doing well and everything else as a basket case. But that's not what's happening, right? You can even see in the regions. The regions traditionally are a lot more volatile. The regions traditionally struggle a lot. But even in the regions, we're seeing some very, very solid growth after COVID. Now remember, this is the past 12 months. It's not even factoring in what happened with people migrating. The only market, what stands out as the only market to you guys that's not as strong, or what's surprisingly weak? Melbourne. Melbourne's been a weak market relative to Sydney and the rest. And the reason for that is, again, population growth. Melbourne was the world's biggest prison during the lockdowns. And what happened is you had a lot of interstate migration outside of Melbourne, and a lot of that went to Brisbane, went to the Gold Coast, interstate migration. Brisbane was the biggest benefactor. Brisbane and the Gold Coast were the biggest benefactors of migration out of Melbourne. Sydney, obviously number 2, but Sydney is more expensive. And regional Victoria was also a beneficiary. Now that's starting to reverse. You can start to see regional Victoria was actually one of the few regions that went backwards. But Melbourne's an interesting market because what's happening, the migrants that are coming in, these are very different to the migrants that were coming in 10 years ago. The migrants that are coming in now, instead of predominantly being from China, a lot of them are from India, Sri Lanka, Nepal, Southeast Asia, and that culture has a different preference for housing than the Chinese market 10 years ago. The Chinese market is very much a high-rise market. They like to live in communities, they like amenity, they like safety. The Indian market is very similar to the Assyrian market. They like land, right? And Melbourne is a very, very sought-after market because you can still go buy land. it's about 10 to 15 years the land price that Sydney was dollar per distance from CBD. So one of the factors I look at is how much a block of land costs per kilometre away from the CBD. And Melbourne is about 30 to 40% cheaper than Sydney. And that market's going to start catching up. So again, this is building a picture for you of where housing is and how the housing market's going.
So Peter,
Yeah.
being medical professional, probably I myself, I don't understand very much in the markets and other things, but what you're saying about Melbourne, is it a good thing to buy lands in Melbourne now, if it still does not caught up with the rest of the states?
The answer is half yes. And I'll tell you the other half when we talk about strategy. No, both. Half yes for both. I'll explain to you why. Before we wrap up where the market is, sales, a very important number to watch, because sales activity gives us an idea of what's happening in pricing and how much turnover there's going, right? The real estate market's not like the stock market or the crypto market where you can take out your phone and see second by second transactions. Sales are done in intervals and we get a little bit of a lag. But you can start to see sales volume, monthly sales volume, and the markets that sales are starting to increase. Now, basically, if you have a look at the 6-month average, we're about where we've been over the past 5 years, but the monthly sales volumes have been quite soft. There's less people selling their house. And this is really surprising because a lot of people thought with interest rates increasing, 15 rate rises, you'd start to see more pressure and more distressed selling. But the data's not showing us that. The data is actually showing that people are doing anything they can to hang on to property that they own, because in a lot of instances, renting is a lot harder than actually paying off that mortgage. That's because the rental market is so competitive. The last thing I look at is I go and have a look at the banks, the big 4 banks, Westpac, CBA, ANZ, NAB. They are the biggest property investors in the country. You know why? Because they've got 80 to 90% of the mortgage market. Every time we go and buy a house, they're the ones that give us money, and they really own our houses until we pay them off. So they collectively own about $1 trillion worth of loans to residential property in Australia. So I like to go and have a look at what the big 4 are doing and what they're reporting in their numbers to see what's happening in terms of people's repayments. And what you can see here is mortgage delinquencies are loans that are going bad, are people that are falling behind on their loans. And we can go to the big 4 banks and see how many people are actually behind. This shows you, this is Westpac, this came out last week. This shows you loans that are behind more than 30 days. They're called 30-day delinquencies. Have a look at that trend. It's basically flat. Loans that have been bad for 90 days or more, under 1%. 99.05% of Westpac's loans are not impacted by any people being late. And then Westpac provides another interesting number. It says even those that are late, they strip out the ones that have a 6-month buffer in their offset account. So Westpac's basically telling us only 0.74% of their loans are more than 3 months late and people don't have buffers left. You can see here the trend, that's credit cards. Credit cards are basically flat. The one big area of concern for Westpac is maybe car loans. 3% of car loans are actually behind for Westpac, and that compares to about 1.5%. But overall, people are doing anything to pay off their loans and to hang on to their properties. Sales volumes are low, and the migration coming into the country is providing more and more demand when needed if homes need to trade. All right, now the fun part. Does anybody know who this guy is? I'll give you a clue. He takes half your salary away from you. He's a commissioner of taxation. This guy's your enemy. For those of you, this is the federal taxman, right? I want you to remember his face. I want you to remember this ugly face, because this face should be a reminder that the more money you make, the smarter you need to get around having a tax-effective strategy, because this guy and his department are going to be there to take as much as they can through the life of your profession, your business, or whatever it is. So as doctors, people come to you with pain and you try to find painkillers for them. Tax is your pain, and the strategy, tax-effective strategy, is your painkiller. So to answer your question, is Melbourne a good market? Yeah, it's a good market. But it means nothing if you don't have an actual strategy that is a tax-effective strategy. This is the biggest problem. I didn't talk about myself because I don't like talking about myself, but I'll provide some context. I've been in the investment game since 2004. Okay, I worked in the stock market for 10 years. I went into financial planning. I've been in a property investment space, built my own businesses. And after speaking to thousands of investors at many of these functions, people always ask, what do you think of this market? What do you think of the property market? What do you think of this house? What do you think of this suburb? What do you think of BHP shares? What do you think of Bitcoin? What do you think of Ripple? What do you think of... And they are all tools, but you need to get your toolbox in order. The tools you use are based on your toolbox and the project that you're doing. So your strategy comes first. And a lot of people are too busy working, and I say you're too busy working to be making money, and you have not dedicated enough time to making money. Your strategy is the single most important thing, and your strategy needs to be a tax-effective strategy. It needs to be a plan. You need to commit to it. It can be here, but you know what happens if it's here? It changes. If it's here, or it's written down, or it's formalized, it becomes harder to change, and it gives you, as physicians, you know the impact of cognitive behavioral therapy. If you write down your problem, your goals, and where you want to go, you have a framework of then tuning your mind into action points to help achieve that. So in property for... Yes, doctor?
Very quick question. At some point they would say, yeah, get more properties, buy, and when you end up buying, you feel so good about yourself, and all of a sudden you get hit by land taxes.
Yep.
And it's like, what am I doing? So every time you want to do something, and then you will get hit by the taxes for everything. And then you think about shares, again, it has advantages, disadvantages in the short term and long term. So it's, and we get a piece of information from our probably, accountant, financial managers, but at the end of the day, you pay so much, and then you end up feeling like you're lost, you don't know.
Yes, of course. Yeah. Of course. I'll talk about that last point. It's called building an A-team. And I'll talk about sort of the importance. But when it comes to your strategy, you've got two options. Welcome, everybody. Thanks for joining us. Welcome. There's two options. This is up to you. There's no right or wrong. We're now getting into how to treat, right? So you can either be a passive investor or you can be an active investor. Some people want to go out and do a duplex. They want to go and build a granny flat. They want to do a development site. They want to roll their sleeves up and get dirt under their fingernails. That's fine, but it's work. Okay, there's no such thing as a free lunch. Some people don't want to do that. They want a passive investment strategy. You decide, but my only advice to you is pick one, because the worst thing you can do is do a combination of both. If you try to do a combination of both, you end up doing nothing, and you'll get confused, and you'll go through, should I do that duplex site? I don't know, I can just go and buy a property and hold it and not do anything. yeah, but this and that, and you go around in circles. So decide, depending on your business, depending on your profession, depending on your relationship. If you want to break down in a relationship, go and build a house. If you want to nurture your relationship, don't do that. But no, in all seriousness, decide whether you want a passive or an active. So when you're building your strategy, start off at the top, active or passive. I need to know, right, what sport I'm playing. Am I playing soccer or am I playing tennis? Because they're two different sports. And then once you're in that lane, cut out all the noise. If you want to go and be a passive investor and you want to buy properties and not do anything to them, the next time your friend tells you about the development site or the granny flat or the renovation, you smile and say, that's great, right? And you automatically cross that out because that's not me. Same way that I'm sure one specialty of medicine doesn't consider the other. I'm trying to use medical analogies today. So depreciation is the biggest incentive at the moment in the market for a high income person to utilize. I'm going to explain to you why depreciation is really important. At the moment in Australia, we have one of the most favourable tax systems to property investors in the world. And the tax system in Australia says that you go out and you earn your income, run your business or you get PAYG, you have your income that you generate, you get taxed on it. But if you go and invest, your gains or your losses can be lumped in and we give you a tax position on a net basis based on these two things combined. Untapped ability to go out and claim property expenses. Untapped. In a lot of other countries, you can go and buy investment properties, and if you lose on them, you can claim up to a certain amount. In Australia, you can go and buy an unlimited number of investment properties, have unlimited number of losses, and use those losses to offset against the tax income, right? That's going to change.